To talk about all of this, we're joined by Dylan Smith. He's senior economist at Rosenberg Research. Dylan, thank you so much, as always, for coming in today. Your thoughts?
Well, there's no way around it. That was a disappointing number. Not only did we see a revision to January, which was, coming into the year looking quite strong. We've missed consensus in February, and it looks like we're flatlining in March. All that points to growth under 1% for the quarter analyzed, I would think, which is well below the Bank of Canada's expectations. And so a disappointing round of growth news here.
You saw the loonie dip as soon as these numbers were released. Are currency markets predicting a June rate cut from the Bank of Canada?
I think that's looking more likely after these numbers. We saw in the minutes from the Bank of Canada's last meeting that there was a segment of Governing Council who were still seeing growth coming in a little stronger than expected and saying that might cause them to push for a slightly later rate cut. That looks very unlikely now after these numbers.
Rob.
Yeah, this is right in line, which, a very, very soft landing here in Canada. I think we're going to probably still skate onside, no major recession here, but just give it enough cover for them to start cutting in June. Maybe we get 3 this year. If it gets worse, they can do 50 all at once in one of the months. I thought they should have done it in April, but I was worried that they might put a little bit of fire on the housing market in the spring selling, so they probably have deferred it, and this data lines up with a cut coming in June, in my opinion. And to my point earlier in the show, start looking at high-yielding dividend stocks that have good balance sheets and are high quality, because money is going to start to flow into those sectors when the rate cut cycle starts here.
Dylan, we're hearing from StatsCan, and not surprisingly, that gross domestic product was led by the mining segments. Gold and copper prices are high. By the oil and gas segment, oil prices are certainly high as well. How should Canadians think about that? That the meager growth that was achieved came from those segments.
Exactly. I think that was behind a lot of the relative strength predicted by economists leading up to this number, was that we'd see this windfall from higher prices helping out on the export front alongside the weaker loonie. And all this just tells us is that domestic demand, investment, and domestic consumption is that much weaker. Those, of course, are the things that are very sensitive to the tight policy stance. And so the Bank of Canada will be looking at this and saying, well, it might be working even better than we thought, and time for a cut. And just to pick up on Rob's comment on the housing market, another thing we saw from the minutes in the meeting last week was a very explicit statement saying, we are aware of the risk on the housing market that, as soon as we cut, we might see a little bump in prices. We don't know how large that will be. But importantly, what they said was, it doesn't matter when we cut, that will remain a risk, right? And so essentially signaling to the market, this is not going to hold us back.
You note that there have been 6 cases in history of the Bank of Canada cutting rates before the Fed, and you've got some thoughts on what that means to investors. Yeah,
I mean, we took a look at this going back in history, because I think there is a widespread perception out there that the Bank of Canada is more anchored on the Fed than they actually are.
Right.
In the last 20 or 30 years, the bank has eased before the Fed because local conditions have demanded it. And in all of those cases, you're seeing pretty much what you're seeing play out right now, which is a sharp weakening of the loonie and domestic equities looking a lot more attractive on a relative basis than U.S. equities, and of course, outperformance in the bond market as well.
Do you agree with Rob that the Canadian economy appears to be headed for a soft landing and no recession?
I don't think this has soft landing in it. I think this has... they might dodge a technical recession per C.D. Howe's definition. At the same time, C.D. Howe's own leading indicator is pointing to even more weakness coming through the rest of the year. So, I say it's odds on that we could see 2 quarters of negative growth coming up.
Rob?
What's your view on how aggressive our bank can do versus the U.S.? Could we get ahead of them by 50, 75? What's the toggle in your mind?
Yeah, so I think, to your earlier point around the housing market, I think once that initial cut happens, there'll have to be a point where we look at what happens to relative financial conditions. Does that lead to a sudden swell in borrowing from Canadians who've been waiting for that signal, and that actually leading them to slow down a little? There's an argument that that's what happened to the Fed in that very dovish December meeting, which caused a lot of enthusiasm that cuts were coming and all this preemptive action. So there will be a bit of wait and see from the Bank of Canada, I think, after the first cut. But based on where inflation's going in the Fed and where the Fed's bar is for cutting, it's quite possible that we could see 2 or 3 cuts before one comes in the Fed.
Is there a level of the dollar, is it 70 cents, that is kind of like, okay, we better not push it too much below that? Is there some views there on the currency?
Yeah, I mean, I think that will factor in. I don't think there'd be a hard number that they'd be looking at, but when you get to around those levels, you do start seeing those negative effects ripple through, and especially through into the inflation outlook. So I think that would be factored in, but I wouldn't call it a hard target.